Let's now have a look at Learning Objective 4, which relates to formal accounting records. So we're going to look now at describing the purpose of the journal ledger and the trial balance. So we've looked at different accounting transactions previously in Learning Objective number 2. So for Circle Films, we went through a whole lot of different transactions and we looked at how they affected our accounting equation. And there's our accounting equation right there. So we looked at how different accounts increased assets or decreased assets, and same with liabilities and equity. Now, in the last learning objective, I explained to you the difference between debits and credits and how they affect the accounting equation. And I said with this particular accounting equation, I want you to make sure you understand that a debit increases an asset, credits increase liabilities and equity accounts, and vice versa. So credits decrease assets, debits decrease liabilities and equity. It's a very important thing to know because that's going to make your life a lot easier when we now work through recording different transactions using debits and credits. And that's what we're going to cover now. We're going to start with how do you actually record a transaction in an accounting journal. We record a journal entry. And this is basically what a journal entry looks like. You have a date associated with the transaction, you have accounts associated with the transaction, and you have amounts associated with that transaction. And as you know, in accounting, we're following the monetary concept, which means that we record all our information from a financial perspective. So the dollars that relate to the different transactions. This is a standardized format that you have to follow every time you record an accounting transaction. Now, when does an accounting transaction occur? As I mentioned earlier on in this workshop, an accounting transaction is recorded at the time it occurs. So that is when something crosses the economic entity boundary. You acquire an asset, you sell an asset, you incur an expense, you generate revenue, etc. You record a transaction at the time that occurs. And this is how you record it. So you write the date of that transaction, you write the account which is being debited, and the account which is being credited. Now, consistent with this standardized format, the account which you debit is always included at the top of the journal entry, right? So you have account you debit, which could be cash. So if we're receiving cash from a customer, we debit cash for the amount we are receiving. If that cash was received as a result of selling an asset, then we would credit in this case. If that cash is received because you are selling an asset, then you would have the asset here, which is credited because you're decreasing that asset, and you would have obviously the same amount as above because the debits and credits need to match in every single transaction. So every single transaction has at least one debit account and one credit account, and the debits and credits need to match in terms of the amount. And that links back to our accounting equation, because if I show you this accounting equation, again, you can see assets equals liabilities plus equity, right? So if you increase an asset account, then you need to offset it with another asset account so the assets still equal the liabilities and equity. If you increase assets, then you might have increased assets, say cash, because you borrowed money. You'd increase the liability side of your equation. Still in balance. So that's why when you record journal entries, the debits and credits always need to exactly match. Now, within this standardized format, what you will notice is the account that you are crediting is on the bottom of this journal entry, and you have indented that account and you have indented the relevant dollar amount. This is the convention that you need to follow when you record every single journal entry. It is just like in Australia, when you drive a vehicle or ride a bicycle, you need to keep to the left side of the road. That is the convention. So when we record accounting transactions, we need to have the debit account on the top and the credit account or accounts on the bottom, which are indented in terms of both the account and the amount that relates to that account. Now, the ledger relates to the T accounts that I showed you in the last learning objective. What is a ledger? Basically, the ledger is essentially a record of every single T account for which there is a T account for every single account we have in the business. So remember I showed you this T account in the last learning objective today. So you have that account for every single account you have. So when we consolidate together all our journal entries, we transfer those amounts to the different T accounts. So let's have a look at this example here. So we have two different journal entries. The first journal entry is on December 1, where we received $1,350 of cash from the customer. And that is for unearned rent revenue. So basically the customer has paid us in advance. So it's like the example I gave you with Qantas. I said, if you bought an airfare from Qantas, so if we look up the Qantas website right now, let's see what's on the home page. Probably the same thing as we saw last time. Here we go. Okay, so it says flight credits extended. So this is basically referring to where customers have purchased airfares, but the services they booked have been cancelled. So they have basically paid Qantas, in this case, $1,350. Qantas received the cash, but Qantas owes them that service and is basically telling the customer that they have the ability to use that amount, the value of the cancelled ticket, until the end of next year, I believe. It says 31 December 2021. That's right. So this is a liability from Qantas's perspective. So we debit cash because they're increasing that asset by $1,350, and we credit the liability because we are increasing that liability account by $1,350. Now, once we record that transaction, we can consolidate that information into the T accounts so we can extract at the end of the period a final balance of each T account. So there's two accounts affected in the December 1 transaction. Cash increases by $1,350. So we debit the cash side of the cash account by $1,350. And unearned rent revenue increases by $1,350. So we credit the unearned rent revenue account by that $1,350, right? Remember, to increase a liability account, you credit. Second transaction, 31st of December, they actually deliver on the unearned revenue. Now we notice it's rent revenue here, not service revenue like in the case of Qantas. But anyway, the transaction would be much the same. It would just have service revenue instead of rent revenue. So they earn unearned revenue here on 31 December of $450. And so therefore they credit rent revenue, which is a revenue account, obviously. And the effect of revenue is it increases the value of the business. So if we want to increase the value of the business through equity, we credit. So therefore, to recognize revenue, we credit that account by $450. So let's start with the first part of this transaction. Here we have unearned rent revenue, $450 debited, which means we're decreasing the amount we owe to customers. So we debit that in the unearned rent revenue account there. And we are earning rent revenue. So we credit rent revenue $450. So we credit that to the T account. So what we've done here with these three accounts in the middle here, these three T accounts, we have consolidated all the information in the two journal entries above so we can work out what the final balances of those T accounts are for the purpose of reporting at the end of the period. The final balance of cash is $1,350. There was only one transaction. The final balance of unearned rent revenue is $900, which is the $1,350 you started with, minus the $450 that was essentially earned, and therefore that liability was reduced. So you're left with $900 owing to customers. And you've earned rent revenue of $450. So that's the final balance there of 450. That's essentially how you consolidate into your T accounts. Okay. Now, if we move on and we have a look at the trial balance, what is a trial balance? Well, all the trial balance does is it essentially lines up all the accounts that we have and sums them all together, right? So it looks at all the debit accounts, which are going to be asset accounts, and your expenses, and compares them to all your credit accounts, which are liabilities, equity, revenues. And so essentially what you want to see when you put together your trial balance is you want to make sure that all the account balances that are debits equal all the account balances that are credits. So you sum all the account balances that are debits and all the account balances that are credits, and they should match. So it provides you with an initial check as to whether or not the debits and credits you have recorded match, which in every single transaction they should most definitely match. It also provides a way of summarizing all the final account balances in one place, so you can then generate your financial statements. And we'll look at that a bit later in today's workshop.